gold isn't just rallying, it's exposing a structural crack in price discovery that most people still refuse to look at. And the funniest part is the crowd screaming overbought is watching the wrong screen. They're staring at the headline price. The real signal is in the plumbing, in the spread, in the willingness of the market to pay up for certainty. And if you stay with me, I'm going to give you the one metric that matters most over the next 2 weeks. The level where the math changes and the exact checklist that tells you whether this move is about to cool off or turn into something that makes $3,500 look like ancient history. Because yes, $3,500, that crazy target, the one people mocked. Here's the twist. The market already pushed past it, and that's precisely why the reallocation story is real. When a dream target becomes a number in the rearview mirror, it's not a prediction anymore, it's a confession. And that's where the real pressure starts. The conflict right now isn't bulls versus bears, it's structure versus narrative. The narrative says this is just fear, just geopolitics, just a trade that ran too far. But structure says something colder. A lot of capital is being forced to rethink what safe even means. And gold is one of the only assets on the planet that can absorb that kind of doubt without needing permission from a balance sheet, a board, or a central counterparty. And the people who make a living selling certainty on television, they can't say that out loud. Because if the crowd believes this is structural, they stop waiting for a dip that may never come on their timeline. But that's not the part that matters. The hidden detail, the one most people miss, is that gold can print a price that looks fine, while the market underneath is quietly screaming about stress. It's the difference between the posted number and the cost of getting metal where it needs to be. When it needs to be there, finance the way it needs to be financed. When New York and London get even slightly out of sync, when the futures curve stops acting like a sleepy storage trade, when the market starts paying extra for immediacy, that's not emotion, that's math. And that math can overpower a lot of opinions. Let's make this real and simple. Gold is not priced like a single stock. A stock is mostly one venue, one order book, one equity story. Gold is a global collateral system with multiple venues, multiple forms, and multiple definitions of delivery. Spot, futures, forwards, swaps, lease rates, inventories, settlement cycles. And the moment those components stop lining up neatly, the posted price becomes less of a truth and more of a compromise. It's the price that clears the most visible market, not necessarily the price that clears the tightest constraint. And if you've ever wondered why gold can feel controlled and then suddenly move like it's been unchained, this is where that behavior is born. Because if the constraint is physical deliverability, the paper market can stretch until it can't. And when it can't, things happen fast, very fast. Here's the framing that makes bigger than Tesla click without hype. Tesla is a giant in equities. As of early January 2026, Tesla's market cap has been hovering around the $4 to $5 trillion range. That's massive. That's history making. But gold isn't a company. Gold is a monetary asset held across central banks, institutions, private vaults, and households globally. And at today's kind of price levels, the above-ground stock of gold represents something like tens of trillions of dollars, roughly around the $30 trillion neighborhood, depending on the price you mark it at. That means you don't need everyone to love gold for gold to move. You only need a small shift in allocation. A fraction. A few percentage points of global portfolios deciding that their tail risk is underpriced, that their currency risk is underappreciated, that their faith in policy coordination is fading. That's it. And once that shift begins, it doesn't behave like a trade. It behaves like a migration, and migrations don't ask permission from pundits. But here's where it gets even more interesting. This move isn't happening in a vacuum. Gold had an explosive year in 2025, one of its strongest annual performances in decades, while the macro backdrop shifted in a way that makes conventional stocks-only poo-poo narratives wobble. Expectations around U.S. rate cuts have been a recurring driver, because gold is a non-yielding asset, and lower rates reduce the opportunity cost. But that's the surface. The deeper driver is credibility, debt math, geopolitical fragmentation. The fact that risk-free is increasingly a political label, not a mathematical one. And that's why this feels different, not because people are emotional, because institutions are rational. And when institutions get rational about uncertainty, they buy things that survive uncertainty. That is the reallocation of the decade. Now let's talk market structure, because this is where most videos get lazy. When you hear gold futures, think of a standardized contract, a promise, traded in size, with leverage, with margin, with a settlement system behind it. It's liquid, it's efficient, it's powerful, but it's not the same as metal. The futures market is where price discovery happens most loudly, but physical flows are where the market gets disciplined. So what do professionals watch when they suspect the posted price isn't telling the whole story? They watch the curve, they watch spreads, They watch whether near-month contracts start behaving like there's urgency. They watch open interest, because open interest rising alongside a strong market can imply new positions, not just short covering, and that changes the pressure profile. And they watch inventories, because not all inventory is equal. And that detail, that's where the trap door is. If you've never heard this explained clearly, lock in. In major futures warehouses, metal can be categorized in ways that sound boring until you realize it. It's the difference between available and actually deliverable against a contract right now. There's metal that's in the warehouse, yes, but earmarked, owned, sitting there as someone's property, not necessarily committed for delivery. And there's metal that's registered or designated as deliverable under the exchange rules. When stress hits, what matters is not how much gold exists. What matters is how much is deliverable at the right location, in the right form, at the right time, with the right paperwork, with the right financing. That's why two people can look at inventory headlines and come to opposite conclusions. One is looking at the total pile. The other is looking at the pile that can actually satisfy a delivery obligation under pressure. And that's where the real pressure starts. Here's the street symptom that kicked this whole thing into the structural lane. The market started paying up for certainty. You can feel it when futures behave differently than spot, when the premium between venues widens, when the curve flattens in ways that don't match a calm carry environment, when leasing and funding costs do weird things. This isn't about conspiracy, it's incentives. If a bank, a refiner, a fund, or a large hedger has a timing constraint, delivery window, collateral needs, month-end balance sheet optics, they will pay more to remove uncertainty. And when enough big players do that at the same time, it leaves footprints, it leaves spreads, it leaves a curve that starts whispering, then shouting. And that's the part casual chart watching misses. Because if you only watch spot, you're watching the scoreboard without watching the game. Now let's put why now on the calendar, because timing is the accelerant. Earlier markets often have thinner liquidity pockets than people expect, because positioning resets, dealers manage balance sheets and macro events cluster. Add the month-end and quarter-end mechanics that funds live and die by, plus the reality that options positioning and futures roll schedules create forced flows, and you get a market that can gap on information that looks minor on the surface. And here's the kicker. The market doesn't need a news story to move. It just needs a moment where liquidity is thin and one side is forced. That's it. That's the calendar catalyst. When the system is primed, small pushes become big moves. And gold has been primed because 2025 didn't just bring a rally, it brought a change in who the marginal buyer is. You can see it in the institutional commentary that has been coming out. Major banks have been openly talking about higher ranges and higher volatility in 2026, with some projections throwing out numbers that used to sound like science fiction, $4 $800, even $5,000 in bullish windows, while also warning about corrections if geopolitical tension eases or if the rate cut narrative changes. That alone matters, because it shifts how risk committees frame the asset. But that's not the part that matters. The part that matters is that when big institutions publicly move their frame upward, it gives portfolio managers social permission to allocate without feeling like they're committing career suicide. That increases the pool of potential buyers. That changes the market's elasticity. And when the pool of buyers gets bigger in a market with physical constraints, the price doesn't move in a smooth line. It moves in waves, violent ones. Now let's stack proof, because one argument is never enough in this game. Proof point one is the term structure signal. In calm times, gold tends to exhibit a carry structure consistent with storage and financing costs. When the curve compresses, when near-month pricing behaves as if immediacy is valuable, you're re-seeing a market that's less about hold it for later, and more about I need it now, or I need certainty now. That matters this week because it forces hedgers and dealers to adjust how they warehouse risk. Proof point two is participation, and we've seen evidence of heavy engagement in futures. Volume and open interest remaining elevated at times, and open interest rising on strong days suggests new positioning entering, not just old shorts closing. That can be bullish, bearish, or both depending on who's doing what, but it always means the spring is being wound, and a wound spring doesn't unwind politely. Proof point three is flows into investment vehicles, ETFs and ETPs, because those are the pipes that allow large pools of capital to express a view without dealing with bars and vaulting logistics. When those flows turn into persistent demand, it matters, because it's systematic. It's not a one-off panic buy, it's a flow. And flows create inertia. Proof point four is central bank behavior, the buyer with the slowest clock and the least interest in your weekly candle. The World Gold Council has documented consecutive years where central bank demand exceeded 1,000 tons, and that matters because it tells you something. This isn't just retail fear. It's reserve management. It's diversification. It's risk management against sanctions, currency volatility, and geopolitical bifurcation. When that buyer is present, dips get bought differently. Not always immediately, but structurally. Proof point 5 is supply chain reality. People assume high prices summon new supply instantly. They don't. Mining is slow. Permitting is slow. CapEx cycles are slow. Refining capacity and logistics can be bottlenecks. Recycling responds, but not infinitely and not instantly. So when demand surprises to the upside, especially demand that insists on specific forms, locations, and delivery windows, the supply chain can't just fix it. It can only ration, and rationing is done through price. That's the mechanism. And once you understand that, you stop being surprised by what looks like irrational price action. It's not irrational. It's scarcity expressed through the only language markets speak. But here was the secret detail that reframes everything. The spread can tell you the truth, even when the spot price is trying to look calm. When there's a premium for New York futures over London spot, when the differential widens beyond what normal carry and FX explanations justify, you're seeing the cost of relocation and the value of deliverability creep into the math. In 2025, there were periods where tariff-related worries and classification questions around bullion bars were reported to have created unusual premiums and strong incentives to move metal. The World Gold Council even addressed concerns around tariff threats and how they could influence flows and spreads, noting signs of normalization at points as inventories built and differentials cooled. The important takeaway isn't the headline, it's the mechanism. When policy risk touches physical trade, the market doesn't wait for a press conference. It reprices the convenience of having the right bar in the right place, and that repricing shows up first in the plumbing. Because if one hub is at risk of friction, tariffs, delays, transport constraints, balance sheet constraints, then the same gold is no longer the same gold. The bar in the wrong place is a different asset for the moment in time. Arbitrage usually closes gaps, but arbitrage isn't magic. Arbitrage requires metal to move, financing to be available, and counterparties to be willing. When those constraints tighten, arbitrage becomes slow, expensive, or selective. And that's when dislocations can persist longer than people expect. And that's where the real pressure starts. Now let's talk about how this turns into a violent price move, because that's what actually holds attention, and it's also what wrecks people emotionally. When gold pushes through key levels, there are often shorts in the system who are not evil. They're hedgers. They're funds running relative value. They're dealers short gamma through options structures. They're participants who are fine until they're not. This is where margin and reflexivity kick in. When you're short futures, the market rising means losses are marked in real time, and your broker wants margin. If the move is sharp, you either post more collateral or you reduce risk. Reducing risk means buying back what you're short. That buying lifts price. That triggers more margin calls. That forces more buying. Liquidity thins because dealers widen spreads to protect themselves. The market starts to gap between prints because the order book becomes less of a staircase and more of a cliff. And suddenly the move looks insane to outsiders. But to the system, it's just forced risk reduction. It's the same dynamic you see in equities during squeezes, but with a different backdrop. Gold-esque squeezes can be amplified by physical tightness and by the fact that gold is a collateral asset. If collateral is under pressure elsewhere, if broader markets wobble, people rush toward what settles cleanly. And that flow can collide with shorts who thought the market would mean revert. But that's not the part that matters. The part that matters is what happens next, this week, this month. Because everyone watching this has the same problem. Even if the thesis is right, price can whip around violently. You can be right and still get emotionally liquidated. So you need a psychology shield. Here it is, and it's simple. Separate trend signal from noise. Trend signal is structure, curve behavior, persistent flows, breakouts that hold, dips that get bought with less time spent below key levels. Noise is the intraday headline roulette designed to make you feel stupid for holding anything. The market will try to manipulate your nervous system. It will give you a red candle after you buy, so you panic. It will give you a green candle after you sell, so you chase. It will feed you confident voices that flip their stance every time price moves $50, so you outsource your thinking. Your defense is a plan built around levels and structure, not emotions. Because the people who get hurt in gold aren't the people who are wrong. It's the people who let volatility pick their timing for them. And that's where the real pressure starts. Now let's address the title's lightning rod. Gold, bigger than Tesla. The point isn't that one is morally superior. The point is that one is a single equity story, amazing, transformative, but still one company, while the other is a global monetary asset that sits in the background of the entire financial system. Tesla can double or halve based on business execution, competition, and sentiment. Gold moves on macro regimes, reserve policy, collateral stress, and trust. When gold is in a true reallocation phase, it doesn't need everyone to sell stocks. It needs enough people to buy gold. And because gold's above ground value is so large, even a modest shift in global allocation can move the price dramatically. That's why this is bigger than any single company. It's not a bet on a product. It's a bet on what the world is becoming. And if you want to know whether this is real, you stop listening to the loudest arguments and you start watching what institutions actually do. The fact that central banks have been consistent net buyers in recent years at heavyweight levels is not a meme. It's policy. The fact that big banks are willing to publish much higher ranges for 2026 while emphasizing volatility tells you something. They see the demand staying strong, but they also see the market structure capable of sharp corrections. That's not bearish, that's honest. And honesty is rare in a mania. Now, about that $3,500 number, in a normal bull market, a target is an aspiration. In a structural shift, a target becomes an inflection point. $3,500 is no longer the finish line. It is the line in the sand that tells you the market has moved into a new bracket of psychology, new bracket of institutional attention, new bracket of collateral relevance. When gold trades meaningfully above that, it pulls in new classes of participants who previously ignored it. Some are forced by mandate, some are forced by risk, some are forced by career optics. It doesn't matter why, it matters that they arrive. And when they arrive, the market changes character. Pullbacks become shorter, breakouts become stickier, volatility becomes a weapon. And if you're not prepared for that, you'll do what the market wants. You will sell the right idea at the wrong time. But that's not the part that matters. What matters is your roadmap for the next 1 to 2 weeks. Because whether you're a macro watcher, a metals person, or a skeptic of institutions, you need a scoreboard. Here's the scoreboard in narrative form, because I'm not going to drown you in jargon. First, watch the key levels that define whether a pullback is just a retest or the start of a deeper correction. A healthy bull structure often allows price to pull back, test a prior breakout zone, and then defend it quickly. The speed of that defense matters. If gold sells off and then snaps back with urgency, that's demand absorbing supply. If gold sells off and churns below a major level for days, that's a different message. Second, watch the curve and the urgency signals. If the curve stays tight, if near-term pricing stays firm relative to later months, if funding and convenience signals remain elevated, it suggests the physical and collateral bid is still there. If those signals normalize rapidly while price tries to push higher, that can warn you that the move is getting ahead of its structure. Third, watch participation. Elevated open interest can mean the spring is wound. If price rises and open interest rises, it can indicate new longs entering or new shorts leaning in. Either way, it sets up potential for a larger move when one side is forced. If price rises and open interest collapses, that can imply a move driven mostly by short covering that may need fresh demand to continue. Fourth, watch flows. Persistent ETF inflows matter more than a single-day spike because persistent flows create mechanical buying. Fifth, watch the macro triggers that can cause violent countermoves. US data surprises, sudden dollar strength, a sharp repricing of rate cut expectations, or a broad risk-off event that forces liquidation across assets. And here, S, the micro cliffhanger. The same event can be bullish or bearish depending on what it does to real yields and liquidity. That's why you watch structure, not vibes. Now let's be fair and talk counterpoints, because anyone who tells you inevitable without conditions is selling you a feeling, not a thesis. Here are the clean ways this story can weaken. 1, a sharp, sustained surge in the US dollar coupled with rising real yields can pressure gold, especially if the market starts believing the Fed will cut less or later. 2, a major easing in geopolitical tension can remove some safe haven premium, at least temporarily. 3, a liquidity shock, where funds need cash, can cause gold to sell off, even if the long-term case is intact. Because in a true scramble, people sell what they can, not what they want. 4, positioning can become crowded. If too many late entrants pile in with leverage, the market can punish them with a fast flush that feels like the bull case died, even if it didn't. And that's why your plan has to include invalidation, not hope. Invalidation, because the market doesn't care what you believe, it cares what you can hold. Now the 2 scenario lens, because this is how you stay sane. Scenario 1 is the controlled pullback and retest. In this scenario, gold pulls back toward a prior breakout zone, volatility spikes, commentators victory lap the top, and then structure holds, the market stabilizes, dips get bought, and the next leg begins with less drama than people expect. This scenario is designed to shake out weak hands and transfer risk to stronger hands. Scenario 2 is the continuation, squeeze, and gap risk. In this scenario, there isn't a comfortable pullback. Liquidity thins, price levitates, and short-term catalysts, calendar effects, data surprises, geopolitical jolts, force participants to chase. This is where gaps happen. This is where you wake up and the price is simply somewhere else. This is also where the market punishes impatience, because if you chase emotionally, you buy the top of the microwave. Both scenarios can be bullish over the medium term, and both can be painful if you don't respect volatility. The difference is what confirms each. A retest scenario tends to show cooling urgency signals while price consolidates, then renewed strength as buyers defend levels. A squeeze scenario tends to show urgency and participation, staying elevated even as price runs, with little time given to latecomers. And that's the part that matters, because it tells you whether the market is inviting you in or forcing you to pay a toll. So what is the one metric everyone must watch that I promised? It's not a mystical indicator. It assesses the relationship between the posted price and the market's cost of certainty, expressed through the curve and the spread behavior between venues and contracts. In plain English, watch whether the market is paying extra for immediacy and deliverability. If gold is rising and the urgency underneath is rising too, that's structural demand. If gold is rising, but urgency is fading, that's a warning that the rally may be driven more by sentiment than constraint. You don't need to be a professional to watch this. You just need to stop treating gold like a meme and start treating it like a system, because gold is a system. And right now, that system is telling you something important. A reallocation is underway, and it's not being driven by one headline. It's being driven by the slow, grinding realization that the world is more fragmented. Debt is more permanent, and policy is more reactive than proactive. Gold is the asset you buy when you don to trust anyone else. It is promised to remain frictionless. That's not paranoia. That's portfolio logic. Now let S bring it home with the $3,500. Inevitable. Framing in a way that S actually useful. If you're still thinking in that old bracket, understand what just happened. The market didn't just flirt with that number, it graduated beyond it. Which means the real question is not, will it hit $3,500? The real question is, what level, what structure, what catalyst would force the market to reprice the next bracket again? And that's where your focus should be. Not on a single target, on the conditions, on what would confirm the move is still healthy, on what would tell you the market is about to weaponize volatility to steal your position. Because it will try, and if you're not careful, you'll let it. Here's the quiet warning. Volatility is going to be used against you. The higher the price, the more violent the shakeouts. The more dramatic the headlines, the more confident the talking heads. They will try to make you feel late, then make you feel stupid, then make you feel desperate. Don't play that game. Build your plan around the two scenarios, respect your invalidation levels, and watch the structural scoreboard. Curve urgency, spread behavior, participation, and persistent flows. If those stay firm, the bull case remains alive even through ugly candles. If those deteriorate while price floats, be careful, because floating price without structural support is where air pockets form. And if you are the kind of investor who is tired of being treated like exit liquidity for someone else, IS narrative, this is your edge. You track mechanisms, not slogans. You track what the market is forced to do. And right now, the market is being forced to admit that gold isn't a side bet anymore. It's a core risk signal. One more thing before we end, and it's the subtle CTA that matters. If you want to be part of the group that doesn't get emotionally harvested by the next volatility wave, stay close to the people who talk in checklists, not certainties. The crowd will always arrive late and leave early. The disciplined community builds a scoreboard and follows it. And if you're still here, you're already not the crowd. You're the person who wants to understand what's actually happening under the hood. Keep that identity. Protect it. Use it. Because the reallocation of the decade doesn't reward the loudest. It rewards the most prepared.